Interest rates have been a hot topic lately, and many are wondering when they'll finally start to decline. While some anticipated a decrease in rates by now, several factors suggest we might not see significant drops anytime soon. The Federal Reserve has maintained the federal funds rate between 4.25 and 4.5%, signaling a cautious approach to rate cuts. Despite market expectations for reductions, the Fed emphasizes the need for more substantial evidence of inflation nearing its 2% target or signs of labor market weakening before considering market adjustments. Inflation still remains a significant concern. In March 2025, consumer prices increased by 2.4% year over year, slightly down from 2.8% in February. However, new tariffs introduced in April are expected to exert upward pressure on prices, potentially pushing core inflation higher by year end. Currently, the average 30-year fixed mortgage rate stands at about 6.9%, according to Freddie Mac. While this is a decline from the previous year, it's still significantly higher than pre-pandemic levels, and many experts predict that rates will remain above 6.5% throughout 2025. For buyers, higher interest rates mean increased borrowing costs, potentially reducing purchasing power. However, waiting for rates to drop could lead to higher home prices, offsetting any savings from their lower rates. Sellers may face a smaller pool of qualified buyers, but demand remains strong in many markets, including Arizona. However, the path to lower interest rates is fraught with uncertainties. One significant factor is the impact of recent tariffs on imported goods, which have the potential to exert upward pressure on inflation. Higher inflation could in turn lead the Federal Reserve to maintain or even increase interest rates to achieve its 2% inflation target. Wells Fargo projects that the 30-year fixed rate mortgages will average 6.9% in 2025, with a slight decrease to 6.5% in 2026. It's important to consider other perspectives. Fannie Mae, for instance, anticipates a more optimistic scenario, forecasting rates to end 2025 at approximately 6.3% and 2026 at 6.2%. These projections are based on expectations of modest economic growth and a gradual easing of inflation pressure. Moreover, the housing market continues to grapple with affordability challenges. Home prices are projected to rise by approximately 4.3%, according to Wells Fargo, further straining the budget of potential buyers. This situation is compounded by a persistent shortage of housing inventory, estimated at around 4 million homes, which keeps prices elevated despite higher borrowing costs. In this environment, even if mortgage rates experience slight declines, the overall cost of homeownership may not become significantly more affordable in the near term. Prospective buyers and sellers must navigate a landscape shaped by a confluence of factors, including monetary policy decisions, inflation trends, and supply constraints. Adding to this complexity is the lock-in effect, where existing homeowners with low mortgage rates are reluctant to sell and take on new loans at higher rates. This phenomenon reduces the number of homes available on the market, limiting options for buyers and sustaining upward pressure on prices. Given these projections, buyers should focus on affordability and considering locking in rates now to avoid potential price increases. Sellers should price homes competitively and highlight unique features that attract buyers. Both parties should stay informed about market trends and work with experienced professionals to navigate the evolving landscape. In summary, while interest rates may not drop significantly in the near term, opportunities still exist in the housing market. By understanding the factors at play and adopting strategic approaches, you can make informed decisions that align with your goals. If you have questions or need guidance tailored to your situation, feel free to reach out to me. And don't forget to like this video, subscribe for more insights, and share your thoughts in the comments below.